Hello, this is Cleare with Financial Strategies Group, and today I want to talk to you about digesting the noise. We've all been hearing a lot of talk recently in the media about signs of an impending recession. You might even have heard about inverted yield curves and how we're currently in the longest period of economic expansion. Also, people have expressed worry about the trade war going on with China. This all means that the shoe's about to drop, right? When the noise, or news, starts to get too loud, we have to remind ourselves to stop and take a look at the underlying data. This is the time to focus on the facts instead of the rhetoric. Gleaning from my experience as an examiner with the Federal Reserve Bank of Atlanta, let's start by looking at the definition of a recession. A recession is defined as a period of temporary economic decline. And it's generally identified by a fall in GDP, or gross domestic product, over 2 consecutive quarters. Since GDP is a lagging indicator, we could already be in a recession or even moving out of a recession before the data is conclusive. The U.S. Bureau of Economic Analysis calculates and reports GDP for the previous quarter 30 days after the end of the quarter. So far in 2019, the Bureau reported 3.1% increase in GDP in the first quarter, a 2% increase in the second quarter, and 2.1% increase in the third quarter. This means when looking solely at GDP data, we're not in a recession. What might the fourth quarter look like? Well, based on recent news of record Black Friday sales and Cyber Monday sales, it'll be interesting to see our numbers. So, what's the current economic data telling us? The economy's slowing down, inflation remains low, unemployment's bottomed out. Also, people tend to believe that a U.S. recession starts when we have massive layoffs, but that's not true. What happens first is businesses stop hiring, and so far that has not happened. One thing's for certain is that uncertainty can cause paralysis, like perhaps political uncertainty. So is our economy taking a pause to see which way the political winds will blow? Now, given all that we've discussed, how should one prepare for a future recession? And how can we help make sure you're prepared? The simple answer is that as your financial planners, we prepare you in the same way we would if there was no recession on the horizon. This means first, always maintaining adequate cash reserves. Ideally, 3 to 6 months of expenses. And even more if you're self-employed. Second, managing your debt and not becoming overly leveraged. Lastly, making sure you don't have money that you'll need in the next 5 years exposed to the stock market. Attempting to try and predict when we'll experience another recession is essentially the same as trying to time the markets. Research has shown time and time again that timing markets and those timing mistakes can cause more harm than good. At Financial Strategies Group, we wholly believe that maintaining a globally diversified portfolio during good times is equally as important as when riding out a storm, like a recession. Try to remember that when it comes to your financial plan, specific goals and timing were put in place for a reason, and trust that it will stand up to the ebbs and flows of the market. Now, while there's no one-size-fits-all strategy that we can incorporate, it's important for clients and advisors to always maintain an open and often communication with their advisor. Please don't hesitate to send us an email or give us a call over any concerns. Again, this is Cleare with Financial Strategies Group, and I thank you for taking time to watch this video.